Rate Reform Initiative in the Market Operations and Analysis Division of the South African Reserve Bank's Financial Markets Department. I now invite our panel to join us on stage. Please welcome our panelists.
Embrace the day, let your worries go. In the morning light, watch your heart unfold. Rise and shine, it's your time to start. Let the morning sun fill your heart. Every day's a chance, a brand new part.
Good morning, everybody. Thank you for coming through today. We are grateful for quite a full house. I will introduce my panel before we get started with the business of the day. On my furthest right, it's Kumar. He is a partner at PwC, and where he focuses on risk and regulation. And he is also the chairperson of the accounting and tax work stream of the MPG. Next to him is Jibar, who heads up regulatory risk and strategy at Standard Bank. She is one of the leads in the MPG's transition planning and coordination work stream, working together with Paul, who will come for two panels later on with me. And to my right is Al-Marie. She heads the Market Risk and Transparency Department at the Financial Sector Conduct Authority, the FSCA, and she also chairs the MPG's Governance and Regulatory Issues work stream. So as Legane said, we're going to unpack the announcement that has been made. It does firm up our Jibar transition plan. We have been talking about it for, as the DG said, for 4 years. And now, at least, everything needs to start moving or gets accelerated so that we make it by the 31st of December 2026. Importantly, it means that the last data point on Jibar will be the one that is published at 10 o'clock on the 31st. After that, we will not publish anymore, and obviously Jibar becomes non-representative. We can touch base on some of the things such as your synthetic Jibar and the likes that could potentially exist after cessation date, but those are the things that we're going to consult on in the early part of next year. Before we get started, I just wanted to give a sense of the size of the problem that we're dealing with. So I will ask the guys, to move the slides for me. Here we're just showing the Jibar-related exposures. And Naweed and team in the early session today, they had mentioned that there's about 43 trillions worth of contracts that are referencing Jibar. About 98% odd of those the related derivatives contracts. And we know, obviously, as a portion of that, it's interest rate swaps. And following that will be your FRAs that most market participants use to manage, the exposure to monetary policy changes and the likes. And obviously, that has implications in terms of what sort of instruments, if you're moving away from Jibar, are you now going to be using and as you gain exposure to Zironium. On the next slide, we start breaking the exposures into the different clusters you'd find on your balance sheet. From an asset perspective, you can see on this graph that a lot of them, if we look at the maturity profile, they are going to mature after 2026. In fact, I think about 75% is going to mature after the end of 2026. And as we show on the screen there, about 65% are 2 years and above. And it's almost natural because you'd expect that your loan contracts, your mortgage bonds and things like that tend to have a very long maturity. The next slide shows the liabilities, similar to your assets as well. A lot of them are maturing after 4 or 5 years, going into your 30-year maturity shown on the graph. Again, it's the same sort of message, which says that there are a lot of contracts that either need to have Jibar fallbacks included, or need to be dealt with as tough legacy. Paul indicated earlier on that the second last session today will deal more in depth around this issue of tough legacy, maybe just defining it a little bit better, what it is, and how we're going to deal with it. We welcome obviously the announcement that the National Treasury has published the draft legislation. This was also one of the major sort of uncertainties that we had coming to this conference, and it actually puts us in a good footing going into the last year of the transition. And I think, do we have one on the next slide, please, Navi? Has it moved on your side? Is it? Okay. The next slide would have shown you the exposures for derivatives, but with derivatives, I wanted just for you to get the sense of what is the component of interest rate swaps vis-a-vis what you would see in terms of FRAs and then obviously cross-currency swaps. We'll add that slide there for you. But here it also shows you the maturity profile for derivative contracts. And unlike the two asset classes, you can see here most of the derivatives should mature within a year or 2 years. And we are going to dive a little bit deeper in terms of your ISDA protocol and the 2021 interest rate definitions. And in a way, this gives you then a sense of how big the problem is domestically. If we're looking at domestic exposures, we do need to move all these 43 trillion contracts to alternative reference rate. The preferred benchmark is Zaronium. Okay, that was the little bit of an intro that I wanted just to make, and then maybe the one last bit is that the DG already mentioned quite a bit around the credit adjustment spread, and those spreads have been published by Bloomberg, so you don't really have to work out the analytics around it, but you're welcome to build your own and come up with your own numbers, of course. And here we are showing the evolution of that credit adjustment spread since we started publishing it. There is a bit of history to it going back beyond this December 2024 if you are interested. But I think importantly for the 3-month tenor there, you can see that as of yesterday actually, it was printing 19 basis points. Interestingly, of course, our credit adjustments rate have been very, very stable. And we did sort of double check just to make sure that the methodology was being applied as designed, and that the credit adjustment was dynamic. So now that the announcement has been made, and I'll start maybe with you, Giselle. When we made the announcement around the credit adjustment spread and Jibar fallback, the recommended methodology for it, we all, I think soon afterwards, the following week, we had ISDA announce that the Jibar fallback had been included in the 2021 interest rate definition, but also the ISDA protocol. And at the same time, Lulegi, in his legal work stream, working together with the LMA, they had issued quite a number of papers advising loan market participants to include Jibar fallbacks in their documentation. Let's make sense of this thing. We're saying that the credit adjustment spread is getting fixed. What does this all mean? And what is the significance of this event?
Thank you. Morning, everyone. Can you hear me? Yeah. Okay. Shall I go ahead? Cool. Is that any better? Okay, thank you. Woo, great start. Okay, so morning everyone. Thank you, Zakele, for that. So I guess it means a couple of things. And aside even from the fixing of the spread, I think very importantly for us as a market, it also means certainty. So like it was mentioned earlier, we've been, and a lot of the MPG, and there's been a lot of work happening behind the scenes. But there's still been a lot of doubt on whether cessation was actually going to happen and when it was going to happen. So I think in terms of certainty, this is the announcement of the cessation dates is very good for the markets in terms of our planning. We all come from organizations, some larger, some smaller, but we all know that when we're trying to plan for these, this massive change, we need to go to governance committees, we need to get approval to spend, we need to do a lot of things behind the scenes, even though we have a lot of commitment to make sure it gets done. So I think that's really important in terms of actually having a date now that we can work towards, and we know, Jibar is coming to an end. All of the work that the MPG and the SARB has done has led to this moment. So I think that's really good for us. Coming to the actual fixing of the spread. So at the risk of repetition, I'll just go through a little bit, in terms of what this means for the market and why the spread methodology was, why we landed here. So as we know from the LIBOR transition, because the old rates and the new rates are structured so fundamentally differently to each other, we needed to account for these structural differences. And this is particularly important for legacy contracts. And legacy, again, we just mean those existing contracts that are now pegged to Jibar. And remember, these contracts, when they were negotiated, counterparties had a specific economic expectation on how this contract would perform. So they decided what the rate was going to be, and based on that rate, they modeled what the repayments, etc., would look like. That rate is disappearing. It is being replaced by a rate that operates a lot differently to the way it's operated. So it's not a forward-looking term rate any longer, but a backward-looking overnight rate. And because of that, internationally, the methodology that was decided to account for those structural differences between the rates was adding a credit adjustment spread. Now, that methodology has been through it's quite a lot of rigorous public consultation internationally and also locally. So locally, before the ISDA methodology was determined as the most appropriate for South Africa, the MPG did a lot of background work to determine how adopting that methodology would work in the South African context, whether it would yield the right outcomes. Because again, remember, we're trying to mitigate the risk of value transfer from changing from the old rate to the new rate. So this credit adjustment spread methodology and the methodology that was decided, the way it works is that there's basically the all-in fallback rate is a composite rate between the credit adjustment spread and the adjusted risk-free reference rate. And the credit adjustment spread is basically the historic 5-year median difference between the adjusted reference rate and the old rate. So that's all very complicated, and we don't need to know exactly how that rate is determined. But we do need to know that the announcement today, in terms of the ISDA protocol, is a trigger event. So what that means is, as at today, that spread is now crystallized. So the spread is fixed as at today, and that is the spread that will apply when Jibar ceases on the 31st of December 2026. So that's really important. And without going into a lot more detail, because I know we will touch on it later, Zakele, that's important in terms of how we make our decisions as a market on how to transition. So like Zakele mentioned, there is a lot of the stock of legacy Jibar currently sits within the derivatives market. And so if market participants decide to include that methodology that incorporates the credit adjustment spread, and they do that through adhering to the ISDA protocol, that is the methodology by which you will transition your derivative portfolio on cessation. Also, as Zakele mentioned, when the analysis happened around the appropriateness of the credit adjustment spread methodology, it was determined that it's not simply appropriate for derivatives markets, although that's how it started, but it is appropriate for the market as a whole. So although the whole market doesn't have the option of a protocol, because the protocol is available for derivatives, it is recommended that even in your cash product transition, market participants consider using the credit adjustment spread, which has now been fixed as at today. Thanks.
And maybe before we move from you, Giselle, if you can maybe expand on why is it getting fixed now? Are we assuming that there will not be any migration in terms of the credit risk of banks? And why are we not maybe fixing closer to the cessation date itself? And at least at that, it's much closer to what market conditions would be demanding at that time.
Okay, so I know part of that question is going to be answered later by a lot of the smarter people that are going to discuss around curve dynamics and what that means. But certainly from a transition perspective, which is the hat that I'm wearing today, from a transition perspective, providing this visibility now is going to be really great in terms of decision making for market participants. So what this does is we finally now have a fixed way to look at the economic link between Jibar and Zoronia. So that is going to help in the derivatives market where yes, it might be appropriate. So now you can start modeling what those impacts are going to look like. And whilst it might be appropriate for a number of your positions to transition using this methodology, it might not be appropriate in all cases. So now we'll be able to observe what the fixed adjustment spread looks like versus what the implied market spread is going to look like going forward. And certainly we saw at the end of the LIBOR transition that those diverged quite a lot. So that being able to observe those divergences really support the market making the decisions that they need to make on how to transition their portfolios.
Sure. Elmarie, as the Financial Sector Conduct Authority, you are worried about conduct risk and in particular the fair treatment of customers. Yes. In what way, I suppose, do you guys regard the credit adjustment spread as achieving some of that? And also maybe what sort of conduct risks are you concerned about going into this last stretch?
So, yes, thank you, Sakili. The transition introduced multiple risks that financial institutions must proactively manage to preserve market integrity and stability. For instance, inadequate disclosures and unfair treatment during transition, particularly in relation to credit adjustment spreads, which may result in misaligned expectations and disputes over economic value transfer. Financial institutions should use clear client communication, apply standardized credit adjustment spread methodologies, and have independent oversight of transition processes, for example, oversight by compliance and internal audit. The failure to adopt robust fallback language in contracts is also a risk that should be considered. For legacy contracts that cannot be actively transitioned, robust fallback language is crucial to prevent economically undesirable outcomes for customers. In this regard, the use of fallback clauses such as those promoted by ESTA is recommended. Financial institutions might prioritize their own economic interests over those of clients during the transition. This could lead to unfair pricing, biased advice, and reputational damage. Financial institutions should implement robust governance frameworks, ensure transparency in pricing methodologies, and maintain strict adherence to treating customer fairly principles. Legacy systems may not accommodate compound in arrear calculations or new Zoronia functionality, and resulting in operational failures, which could disrupt trade processing, settlement, and risk management. To mitigate this risk, systems should be upgraded. Jibar impact assessments should be performed, as well as industry-wide testing for Saranya integration. Liquidity risk should also be considered. At the early stages of Saranya adoption, trading volumes may be low, resulting in limited market depth. This can increase volatility and impair price discovery. In this regard, robust liquidity monitoring framework should be developed to track depth and spreads. Establish contingency funding plans for periods of illiquidity. Transitioning to compounded in arrears calculation introduces complexity and valuation models, and incorrect assumptions or coding errors can distort risk metrics and profit and loss. Mitigation strategies for this is to validate and backtest models against historical data and industry benchmarks, conduct independent model reviews and governance oversight, and to implement robust change management and documentation processes, train risk and valuation teams on new methodologies. Then there's also a risk of operational concentration. This is when there's a heavily reliance on third-party vendors for system upgrades or fallback implementation, which creates dependency risk. Vendor delays or failures could disrupt operations. So to mitigate this risk is diversify vendors and avoid single points of failure, include robust SLAs and contingency clauses in vendor contracts, perform regulatory vendor risk assessments and resilience testing, and develop internal capabilities for critical processes where feasible. Then there's also a risk of market fragmentation. If institutions adopt Saranya at different speeds, liquidity might be fragmented across benchmarks, impairing market functioning and increasing complexity for participants. Industry-wide coordination and harmonized timelines should be promoted. Regulatory guidance to ensure synchronized adoption should be provided. A poorly managed transition, client disputes or misrepresentation of risk could erode trust in financial institutions and the credibility of benchmarks. And in this regard, transparent communication plans for clients and stakeholders should be implemented. Marketing materials should accurately reflect risk and liquidity considerations. A client dispute resolution framework specific to benchmark transition should be established, and regular external and internal audits of transition practices should be considered. There is a risk that Saranya-linked products may be marketed as risk-free without adequately clarifying liquidity constraints and volatility considerations. Incorrect assumptions about liquidity and volatility may affect pricing models, hedging strategies, and risk-adjusted returns, leading to unexpected losses or FTP distortions. A comprehensive pricing framework should be in place, incorporating credit adjustment spreads to reflect credit and liquidity risk, ongoing industry testing to validate assumptions and methodologies, and clearly communicate that while Saranya is robust, a robust benchmark, products linked to it are subject to liquidity constraints and market volatility, which can impact pricing, returns, and the ability to exit positions.
All right, and maybe we'll pick one aspect of that, which is communication, and I'll come to Kumar, because you would advise your clients around accounting disclosures for the users of financial statements, and I suppose they, in particular, your investors and the likes. How should companies think about accounting disclosures now that we know that Jibar is definitely going to be discontinued towards the end of 2026?
Thanks very much, Zakele. So, look, I think today's announcement has been wonderful for everyone, more than just for accounting, because it gives us a timeline to work towards. Many of the discussions that we've been having with clients is around, how fast should they undergo this transition, And I think with certainty around how much time you actually have before cessation, that enables, to put a robust plan in place, which many of the colleagues have already spoken about. In terms of the accounting disclosures, I think for many, and I'm sure some of you in the room with December year ends are delighted at the fact that there's an announcement now, which means that there's some work to do before December year ends in terms of populating those disclosures. I think initially, the first thoughts are, we were disclosing as part of IFRS 7 already what are the impacts of the transition, what are the qualitative and quantitative impacts. I think now with an actual cessation date, there's considerations to be given about whether the certainty is there, in which case we've seen in other markets it does provide certainty for you to now end your phase 1 accounting reliefs that have applied. There's still a lot of discussion at the moment about whether it is enough uncertainty that has been dispelled to do that, but I think having looked at the international views, we should be there at that point. Further disclosures now are going to really involve, have you got all of the data that is linked to your instruments? Are you able to pull together that data and quantify what is the economic impact to your balance sheet? Now that data set and pulling together that data, depending on the size of the organization, can be very difficult to do, especially now for a December year end. So, chatting to many of the colleagues at the moment, there's going to be work to be done now around, can you pull together everything to quantify what this means for your December year ends and then disclose what that quantitative impact will be. But I think the key message here is, the disclosures aside, it's really the impetus now to transition. And I know we've got a session later which will talk about transition. But when we talk about an active and passive transition, from an accounting point of view, and indeed for all of the other areas that are impacted, you want to start thinking about how you're going to phase this and move this across. Because ultimately, as you think about your accounting and how you want to migrate your instruments, everything is linked, from the contracting on what constitutes a modification and what doesn't, ensuring the legal teams and front office teams understand that for renegotiation purposes. That all filters into accounting and tax. So everyone needs to be on the same page. And as Almarie also mentioned, getting your systems in order to be able to transition those instruments as you intend to is also important. And we've also seen that trip some of our clients up. So I think for disclosures, there's going to be work to be done in December. We yesterday had an accounting and tax workstream meeting, and there's a lot of attention being paid now to the transition, given that the announcement happens today. There's going to be a lot of market questions that might come out of it. We just encourage, if there is anything, please include those questions, send them to us, and we'll look to give guidance to the market where possible.
Sure. And as you say, that deciding on your transition approach becomes quite important if you're going to have good accounting disclosures. Maybe, Giselle, you can come in here, because the MPG is thinking about publishing transition guidelines that somehow also discusses what we mean by active and passive and legislative sort of transition. So maybe just expand on that, and then afterwards we'll just open it up for questions from the floor.
Okay, thank you. Okay, so yes, so when we are thinking about transition approaches, again, we're thinking in terms of the legacy positions that you already have. So the final pillar of really what was the initial Jibar transition plan that was published. So remember, pillar 1 and pillar 2 was focusing on creating liquidity in new positions. Pillar 3 was then focused on how do we now transition the legacy positions we have. So the approaches that have developed and certainly are aligned with the offshore trajectory of transition are passive, active, and legislative. Now, a passive approach denotes the where what we're doing is in a dual rate environment, so where Zoronia and Jibar exist together, you will implement some kind of robust fallback into your contract, but you continue to peg that contract to Jibar, right? So even though today you could renegotiate that contract to Zoronia, you don't do that. But what you do is you put these fallbacks into your contract that will govern what happens on a trigger event. So when Jibar ceases, this is how we will transition transition our contracts. So obviously the most recognizable passive transition is the ISDA fallback protocol that's been made available to the market. But obviously market participants and many market participants have done this, have elected to include fallback language into their contracts. Now, what we know from internationally and the preferences of the regulators is, although passive inclusion or although passive transition is good in that it's certainly better than not doing anything. So it's certainly better than leaving your contract to potentially go into default or some kind of other contractual issue that might create contractual certainty from when the benchmark ceases. So it's certainly better to passively transition. There is a preference toward an active transition. And what an active transition is saying today, even though I have a legacy position, I will proactively renegotiate away from Jibar in that position today. So I will go to my counterparty and say, look, we have this position. We could wait until Jibar ceases and we could implement fallback language, or we could decide today to actively renegotiate that contract to Zoronia. Now, the one thing that I often say when we're having this kind of discussion is I think market participants almost hear the term passive transition and we automatically think that that denotes almost the level of activity or the level of effort you're taking. And that's certainly not the case. So it really might be that even in a passive transition, you are taking a lot of active steps to renegotiate the contract. It's just that you haven't renegotiated it away from Jibar today. So, don't have any kind of issues with that wording. It certainly doesn't indicate that you're not being proactive. And then the last approach is the legislative. So that will apply where passive fallbacks have not been included into a contract. The contract has not been actively renegotiated towards Zoronia. And in fact, either nothing was done or, and again, potentially through no fault of the market participants. So, for example, if you have a non-performing loan or if you have a counterpart that you can't get hold of to renegotiate, in that case, you will have the legislative solution that will apply. As it was mentioned earlier, the amendments to FSRA, the Financial Sector Regulation Act, have been made available. And what that does is it empowers SARB to designate a replacement benchmark. So to the extent you still have a Jibar referencing contract, as at the 31st of December, you don't have robust fallbacks in that contract that govern what happens, the legislative solution will automatically read in a replacement of benchmark. Now, why that's important for the market is that it does provide contractual certainty. So in those instances where you have not been able to amend your contract continues. It doesn't, fall away. It doesn't create any issues from that perspective. But I would caution that we know it is the stated intention that potentially different segments of the market will have different designated replacement benchmarks. So this is really important for market participants to consider. And even though the legislative solution does provide that contractual certainty, it does potentially create issues in terms of, package contracts. So when you have a derivative, for example, or you have a loan and you have a hedge in your derivatives contract, what happens there is you might potentially have different replacement designated benchmarks in that instance. So it is really important that market participants consider the most appropriate approach for their positions. And we certainly believe, and it's what we've seen offshore as well, that it might be, particularly for a large organization, it might be that you are taking a hybrid approach. So for your derivatives positions, you might decide that because the ISDA protocol is particularly robust, it's been tested under the offshore transitions, that you will transition your derivatives according to the ISDA protocol, but you might want to actively renegotiate in other situations, and you might also be forced to rely on the legislative solution for tough legacy positions. So it's really important that when market participants are approaching the transition, and certainly now that the announcements of cessation has created an economic link and you can compare the outcomes, it's really important that you consider what's going to be most appropriate and preserve the level of control and autonomy that you would want to have over your contracts, to prevent that automatic legislative reading in where it might not be the most appropriate in some circumstances.
Sure. Let's open it up to the floor. If you've got any question for the panelists, there are mics on the tables. This is the time to ask a question. Please go ahead. And maybe just introduce yourself so that,
So this is Michael from New Development Bank. So we have liabilities, like we have issue bonds based on Jibar. And we also have assets linked to Jibar with loans and also other assets. So as you mentioned that it is preferred, encouraged to have an active transition maybe before the final date of cessation of December 31st next year. So what is your advice of the steps and timeline for these different assets liabilities? For example, for loans, because the cash has been fixed now. So do you think that we can start to renegotiate and transition from our existing legacy loans to Zeronia right as soon as possible? And as cash also fixed, so do you think bonds and the derivatives can also be actively transitioned with the same pace or timeline? Or you think these different types of liability and assets should have different pace according to your view for that?
Okay, I will ask Giselle to come in on that one, but I will also like to invite Andres to also come in around bonds in particular and how we are thinking about the transition for them, maybe just high level. I suppose in particular, what are the challenges? Because obviously you've got now many holders and you've got all these bond indentures that you cannot necessarily negotiate effectively. So you can come on that, and then maybe specifically in terms of some of those instruments that you've mentioned. Yeah.
Okay. Thank you. Yes, so we certainly in the paper that's been published, it's recommended that an active transition is the best. So, and again, I think prioritize first those positions that do not have robust fallbacks. So where there's any doubt around whether you have adequate or robust fallbacks, I think prioritize those. I certainly think start the conversations. So what we did find, even when we were transitioning previously, was one thing that a lot of organizations struggled with was creating that single view. So how did you know across your derivatives and your loans, etc., which positions were linked? So I think that's quite important from an organization and having those kinds of joint conversations. Also, and not to preempt anything that will happen later, but we don't yet have a term rate, right? So we don't yet have, as they mentioned, there was a request gone out, and vendors are invited to put their names, put their hats in the ring to provide a term rate, but that's not yet settled. So we certainly don't have, especially for your loans, right, where many banks want to use the term rates. So I would advise get close to what's happening. I would advise against waiting for a legislative solution, and not to preempt what the regulators might say, but I think that's probably the regulators' preferred route as well. Because remember, there's also going to be supervisory reviews where they look at how are you approaching this, what have you done within your organization. That being said, I would advise that you get close to what is likely to be the legislative designated replacement benchmark. So those things are already being discussed. So how you will in your loans, what is likely to be most appropriate versus in your derivatives. I certainly believe that barring, an exceptional circumstance, the ISDA fallback protocol for derivatives has proved particularly robust. But again, you might want to, and maybe it's useful to clarify this for the rest of the market as well. Even though you have signed up to the protocol, you may still elect with your counterpart to take a specific derivative contract out of application of the protocol. So we certainly found that when actively having these conversations to renegotiate, we would sometimes say, okay, for this specific position and to mirror what's happening in our loan or in our cash market position, we will actively renegotiate the derivative position, even though we have the fallback that we could rely on, but because we wanted consistency. But I certainly think the conversation, you should probably start that now. Also, I think because different parts of the market are really at different stages. And I think particularly some market participants will have a role to play in terms of education, in terms of providing. So, we can sit and say passive, active, legislative, but your counterpart is going to want to know, what does it actually mean if I do that? Can you model for me the economic outcome? And I know certainly, again, toward the end of LIBOR transition, we found ourselves in the position where counterparts were coming to us to say, okay, I'm happy to do compounded in arrears, but can you do like 17 days for me? And can you mirror that? And what if I chose 17 days or 6 days or 5 days? Or what does all of that mean? So I do think, to model those outcomes and those impacts, it's going to be really important to start the conversation. There's certainly nothing stopping the conversation, particularly now with the cessation date being announced. I think it really facilitates having a conversation now. So certainly that would be the recommendation.
And then maybe for those listed instruments and the complexities around those.
Thanks, Akile. My name's Andrew Stutway, first round. I'm so tempted to answer him, but I'll reference to the bond market. I think if you stand back, the one component is still outstanding, as the DJ has referred to, is the forward term rate. That forward term rate, in order for valuations of the bonds, are critical. So what we are proposing, that it has to go via the governance cycle before maturity, or let's call it cessation date 26. So proposals will have to be given to the bondholders in order to get approval, either on a voluntary basis, otherwise it will follow in the tough legacy contracts. And if we have the final component part, if we look to what happened internationally, most of the bondholders go into the new one. Because before and after, the South African economy is fully funded. So one just have to make sure as you transition, there's no winners and losers. And it's probably the easiest way to look at it is you want to match your cash flows. That your cash flows on an ALM doesn't reprice. Thanks, Zakir.
Thank you. Any other question? I can't see on the other side. We must have been clear. Responsibility for communication. Your financial statements obviously will cover your investors and other users of financial statement. And is there any obligation now to start communicating to your clients, your customers? And if there is, what advice would you give to the participants? And maybe Kumar, and then we'll come to you, then Elmarie.
Yeah, excellent question, because I think we referenced the retail market earlier in particular. I absolutely think that education as part of the transition is very important. Why? Because, and Elmarie sits in that world, the conduct issues that you can run into here, if you aren't able to explain to a client why is the transition happening, it's not a regulatory change. This is a market change that we're going through, that's driven through sometimes a legislative instrument, but it is a market change. So it's not that the bank is trying to change the rate because they have a better rate that they want to put forward in front of you. It's a market change and the rate will disappear. I think it's really important to educate clients around the transition, not just in the retail space, but even in the corporate space. What we have seen, having gone through the LIBOR transition in particular, some of the less sophisticated corporates that haven't thought about the transition, again, engagement with them. Do they really understand what the impacts are? The fact that they might be on a current term rate and now they're going into a backwards-looking rate in arrears. Do they really understand the implications of that, especially if there's no term rate available before they transition? It's these sorts of things which clients ordinarily wouldn't pay attention to, and I think it's very important for everyone that's offering any Jibar-linked products at the moment. Make sure that you've got appropriate disclosures either on your web pages or your front office teams are equipped to be able to have the discussion and have the discussion that is aligned to the view of your transition team. So, you know, are you going to go talk to a client in a particular way? And if that counterparty has several different instruments with your organization, do you approach them once? Do you approach them multiple times? If it's multiple, is the same story being told across those different teams? It's these things which, you know, from a communications perspective, become really important for conduct, because you don't want a different story, you know, being put out to the market.
And I think, Sakele, Kumar touched on external communication, but internal communication is also important. So the staff should be, especially the client-facing teams, should be trained. They should understand the transition, the implication, and the roles that they need to play. The departments, all the departments within the organization should be aligned in respect of timelines, responsibilities, and governance, and also to prepare for operational readiness and client queries. So it's important to also create, and I think we have emphasized this, you know, throughout, that there should be governance structures and oversight. You know, for instance, maybe an oversight committee or a benchmark transition steering committee that drives the process, to define also clear accountability and decision-making, this escalation. So staff should be educated on Sarania methodologies, compounded in arrears calculations, credit adjustment spreads, and fairness principles, TCF, and conduct risk and regulatory requirements. And also, we've seen that to have frequently asked questions on your website, or also, you know, share that with your staff, is also a very important communication medium and education type of, that can be used for education purposes as well.
All right. I think this is a perfect place to stop. Consider that we've run out of time. Thank you very much. Please enjoy the rest of the conference.
Thank you.
Thank you very much to our panel for those invaluable insights. A few notes and announcements. We do apologize for any operational snags that have been experienced today. It wouldn't really be a historic occasion if everything went according to plan, would it? So we appreciate your patience while we sort everything out. And over